they get that tax hit, 40-50% of it's gone to Uncle Sam for nothing. They don't want to do that. They'd rather take it, postpone the tax hit till later in life, right? Until they really need the money.
How in particular, our show is Capital Gains Tax Solutions, so we're helping people create and preserve more wealth through capital gains tax deferral, in particular investment real estate, but other vehicles as well. So for yours, it's investment real estate. Before the show, we were mentioning a couple things. Have you ever had any challenges with capital gains tax? And you're mentioning a deal that recently happened. Would you walk us through that deal and perhaps some of the challenges there that was facing both the buyer and the seller?
Sure. Well, you know what? When you're So there's a 148 unit deal in Cleveland here. And when you're looking at deals, when you're putting these deals together as a syndicator, right, which is what I do. And one of the things that we have to work through as a general partner, my partner and I, we have to really assess the deal itself, put the deal together, figure out the structure, figure out the business plan, the whole 9 yards. That's what we're doing, right? So for the limited partners, all they're doing, I shouldn't say all they're doing, but what they're doing is they're putting in the money to help us acquire the asset, right? But a big part of putting the deal together is assessing the seller. Is the seller for real, right? The same way they're assessing our ability to close, which we have proven that we can close. Every single deal we get under contract, we close. We've never flaked on a deal ever. We never will. So I won't say anything bad about the guy, but he's got some issues. All right, he's got some problems. I'll just leave it at that. And the thing is that one of these issues that he had was related to 1031 stuff. So we're supposed to close the deal a little bit earlier in the year, and it just kept getting pushed off for one reason or another. Not our fault. And here we are. Now we're in December. We're in the last 2 weeks of December, and the seller is still trying to push the deal off. And we're like, what is up with this guy, right? Like, why is he trying to do this? Like, what's going on, right? We had some 1031 money that had to get into the deal. So we had to close before the end of the year, before the end of 2019. We had to close, right? Otherwise, all of our investors would get screwed. Well, it turns out he had investors that had to close the same thing. They had to close by the end. They had to close by. Well, he wanted to push off to January. I'm sorry, he was trying to push it off into January to realize tax benefit. Then we had to close it off before. So now we're at odds, right? He's trying to flake on the deal, and not flake on the deal. He's trying to push it off. He's trying to do as best he can, right? But fortunately, the way that we did it was we have a very good contract with very good attorneys that were able to enforce the agreement and get it closed on I think it was December the 28th or something like that.
And again, why was he trying to push it off?
Right.
Why was he trying to push it off? What was his motivation there?
Because they would have realized a capital gain or something like that by the end
in the
of
given
year,
year, right? So he wanted to push it out to another year so he could delay it, because essentially then it's not going to be so the following tax return. So essentially you can earn interest on the money that you would have had to pay to the government earlier. Now he gets a whole year of keeping that before he has to pay it. Is that correct?
Exactly. So there's stuff like that, and that's why it's important, crazy important, to make sure you have a nice tight PSA. Make sure your attorney will draft language and protect you as the buyer against such things like this. Because what they'll do, it depends on the seller too. If the seller is somewhat difficult to deal with, they'll come up with reasons why they should postpone the deal, right? And you just got to be diligent and make sure your agreements are written so that can't happen. That's the key.
Excellent. And then the buyers, they were on their own 1031 as well. So they had some time, some 180 days to close, but 45 days to identify. And they're also pressured with getting this thing done.
Exactly. So we had to perform. We had to close it.
Mm-hmm.
So the seller wasn't happy, but c'est la vie, right? Got it done.
Yeah, exactly. And he needs to, due to his word and due to the contract, what he signed to do, not just out of preferences for himself. So yes, that is that is the pressure that the capital gains tax absolutely provides. And then curious too, Agostino, how do you and your clients either defer or eliminate or mitigate some capital gains tax? What's sort of your strategies going in and out of deals? Any wisdom you can share with our listeners here?
Yeah. I mean, the great thing about the kind of stuff that we're doing is our investor partners, they're just putting money into the deal and they get equity in the deal, right? So we'll do a refi. We'll basically get that money back to them, and or what typically happens though is that they leave their money in the deal. Say we go to sell a deal. So we buy a deal in year one, we sell it in year five. There's a big windfall of cash that would be coming to them. What they do, because they don't really need the money, this is an investment for them. We'll take that money and we'll roll it into the next one tax free. That's the beautiful thing about doing this type of multifamily real estate thing. So, which is also a reason why if you're getting started in this business, there's plenty of that money out there. You just got to find it, right? So if you have an investor that has maybe they've already rolled this money 3 times and they're sitting on $500,000 in one deal that's going to be sold soon, you approach that investor and say, hey, listen, I'm trying to raise money for this deal over here. It's a great deal. Here's why. You make your pitch, you explain your return, what the structure is and all that. That investor gets to invest an entire $500,000 that they would have coming to them straight into that deal without getting taxed. They're looking for deals. They want to put their money into deals because they don't want to get that tax hit. They get that tax hit, 40-50% of it's gone to Uncle Sam for nothing. They don't want to do that. They'd rather take it, postpone the tax hit till they're later in life, right? Until they really need the money. That's what they want to do. There's plenty of that money out there. There's trillions of dollars sitting out there right now. The thing is though, other people have that money. And the only way you get your hands on that money is by networking and talking to people. It's the only way.
And curious, are you using a 1031 exchange? Are you using opportunity zone? What's the vehicle you use to roll that when you say roll? Is it 1031?
Yeah, it's 1031. It's 1031 right now. Yeah. We are, there's a deal I'm working on right now. It's a huge deal in downtown Cleveland. It's going to be massive. It's going to be awesome. I'm very excited about it. Can't really share details about it right now, but that's an opportunity zone. However, because of the tax credit situation, we have a whole lot of other tax credits on this historical asset. We can't, the attorneys had to go and figure out, okay, is it worth doing OZ or not? And we've opted not to use OZ on this deal, but it's not to say that something won't happen in the future, but opportunity zone stuff could be.
Got it. And so you're going to form this entity and allow 1031 money to come into the entity. Is that like a tenant in common? Walk us through
Correct.
that.
Yeah, so it could be just 1031. It could be a TIC, a tenant in common as well. It just depends on what's going on specifically in their life, right? But usually it's just 1031 money that rolls in. Usually is what it is.
Excellent.
Yeah. So in that case, they own no more than 20% of the limited partner because that limitation, right? So even though someone may want to put in $500,000, for instance, well, in that deal, $500,000 would be fine. It's a big deal. But they technically can't own more than 20% because if they do, then they have to give up their personal information and they're going to be on the note, which is obviously what many limited partners don't want to do. They don't want to be on the note. They don't want to have to take on the additional responsibility, and they shouldn't. They shouldn't do that anyway.
Got it. So if they're doing 1031, they just can't be more than a 20% owner. Otherwise, then it creates another challenge. So you kind of got to fit that. But you also don't want it too small because maybe it's a little bit of a headache. So it's kind of that it's a little window there that you have to capture for it all to work out, like a puzzle piece.
Yeah, exactly. I mean, it depends on the deal size, right? I mean, in this case, it's going to be a very big raise. We can't, to raise $100,000 at a time, that'll probably be the minimum. And typical deals that we do maybe 25,000, it depends on the deal size, right? Because just as you said, we're trying to keep the investor pool to a manageable size because every time we have a deal, we're managing the investors too, right? I don't mean managing in a bad way. It's about, we have to report to the investors. We have to meet with them. We have to talk to them, that kind of thing. And it's easier to deal with, like, say, 3 investors than it is to deal with 300 investors.